Hello, everyone, and welcome to a special episode of the Australian Retirement Podcast. I'm really delighted to have today a really good mate and professional, Chris Bates. Chris, hey mate, thanks for being on the show.
James, it's always good to chat. We've known each other for a long time, and we're both part of the Rask community now, and both got different shows. But yeah, it's exciting to do this one with you because we're very similar minds when we think about these things from both a financial planning point of view and a property point of view. And so it's going to be a good episode.
Yeah, couldn't agree more. So for everyone that's listening on the Retirement Podcast, Chris is the co-host of the Australian Property Podcast, which is also under the Rask umbrella. So that's your source of financial goodness for everything property related. Chris and I know each other for almost a decade, I'd say, mate, because we were both financial advisors. And then one day, Chris just said, "You know what? Blow this for a joke. I'm out of here. I'm going to leave and go and become one of the best mortgage brokers in the country." And that's what you're doing, mate.
Yeah, that's right. I've come from an advice background. I absolutely fell out of love with advice, to be honest, and all the things that go with it and delivering it, all the regulation, etc. And just felt absolutely in love with guiding people on their property decisions. And the best role I could play there was as a strategic mortgage broker for them. And we actually now partner with financial advisors, so we sort of can go full circle, and we're back there. And yeah, we act as mortgage brokers, but we play a little bit more of a property guidance role as well, and then linking them up with the right buyers agents. And so. Yeah, we come from the advice background.
Yeah, brilliant. Well, today's going to be one hell of a show because, of course, the focus is around optimizing debt for pre-retirees. We talk so often and we get so many questions in particular about debt, how to manage it. And of course, a lot of people might look at things like, for example, investment properties and getting that home loan and think logically that this is a good decision. But it starts to get a lot more cloudy for people as you are thinking about your years to come in retirement, and more so when you actually enter retirement. So we're going to talk in some detail about how you optimize debt and the things that you need to think about more broadly when thinking about debt and how it plays with your finances. So you ready to rock and roll, mate? Let's add as much value as we can.
Absolutely. Let's do this.
Well, I think the right place firstly to start would be to let's differentiate between the good debts and the bad debts. Do you want to speak to this?
Yeah, I think I guess it depends on how and as you get closer to retirement, I think debt becomes even more scary than when you say in your 30s, 40s, and it's just the way it is. I mean, obviously, bad debts are things like consumer debts and things that are non-deductible debts, car loans or personal loans, etc. Things that are basically buying assets or spending money that are depreciating. I mean, often though, sometimes people think homeowner debt is bad debt as well. And I think it's not a bad way to think about things as well, because it's non-deductible, so it can be expensive when interest rates are high, and you've got to be really careful taking it on because it can get really expensive, particularly in the last few years when interest rates have been high. And if you had a big debt, for example, on a home, and the asset wasn't a great asset and it wasn't growing for you, then you'd have to argue that's been bad debt. It's been a poor decision to own that home. So yeah, I think homeowner debt is something that you've got to be careful with. And then I guess it's also if you're using debt to buy investments, I don't think that's always good as well, because you've got to have that same mindset. You've got to be like, okay, this is better debt than bad debt because it's deductible. But if you're not buying good assets with it, or you're not using it wisely and buying, whether it's shares or property, I think that's bad debt as well. And so, yeah, you've got to be really careful with using debt. It can amplify returns, but also it can really hold you back if you use it wrongly.
Yeah, I really love that philosophy of thinking. Just because you're buying like shares or property, for example, doesn't necessarily make the whole thing justified. It just requires you to have a lot more care and a lot more due diligence in order to justify taking the debt out, right?
Yeah, absolutely. And I think I think a lot of people have just gone down the investment property route and that, oh, it's good debt. I'll get a tax deduction. I'll just go and buy something. And even Cortality released their pain and gain report just in the last week, and and that sort of shows that people are losing money on property every day. And they're the stories that don't get shared around the barbecue. And so they might think that they've got some good debt, but obviously they've gone and bought bad assets. And so I think that's bad debt, because you've and people, and that's just the reality. So you got to be really careful whenever you're using debt, and it shouldn't be you against it, but you just got to make sure it's going to work for you.
Yeah. Well, nice to hear a pragmatic view from a mortgage broker. That's really refreshing. Now, To add to that though, let's hook back for just a second to talk about the home because you make a great point. I find this one really fascinating, which is that you'll often meet with someone who might be in their mid to late 50s, for example, and they say the kids have moved out or they're going to move out. So we're looking at buying a new home. But for whatever reason, we're looking to upgrade, not downgrade. We've decided that we're going to buy one hell of a lifestyle property, something we're going to buy, the perfect place on the top of the hill, or we're going to, like, although the bedrooms might go down, we're actually going to spend more money, or that's the plan. And often when you look at that in the broader context of people's decisions, sometimes they're like a luxury choice that you can afford, but sometimes it's a case that just circumstantially we want to, like, maybe you're starting again because of a separation and okay, I'm going to buy a home. Great decision, but again, taking out that debt at that point, you're going to have this non-deductible debt potentially in your years as you approach retirement. If that's not managed really well, that's a big problem, right?
Yeah, I think when you get to retirement, you want to have as many access pools of money that you can access, and I think you don't really want to become asset rich and cash poor. And unfortunately, when you get yourself in that situation, you probably have to change your lifestyle, maybe a bit too conservatively than what the way you should be living your life in your retirement and actually enjoying these years. Um, or you potentially have to sell assets to sort of fund cash flow living, and that's it. You're at the mercy of the market, right? So if you have to downsize, well, is the market really good at that point, or is it not? You have to sell your investment property because you need the cash, or you have to sell your shares or your super down. And I think when you get to retirement, you want to sort of, have the flexibility to pull on different pools of money, regardless of where the market is, and live on income, let's call it, rather than having to sell assets. And I agree. When you get to retirement, you do want to not have the pressure of the concerns of interest rates, or your cash flow could change dramatically because times can be a bit tougher there when you haven't got the income coming in.
Agreed. Let's talk about times when it works. You're looking at, perhaps you're not necessarily a pre-retiree on the cusp of retirement a year to go or something along those lines, but more broadly, you might be in your, let's leave the age out, but you're in a phase of your life where you're starting to think about retirement. You're starting to think about all of the levers that you've got to boost your wealth and give yourself the most the most successful retirement you can. Debt can play a good play. It can play a really good part here in the right circumstances. Can you talk about the, like, when you sit down with people who are doing it well, what does it look like?
So I mean, I guess if it's someone's maybe like a few years from retirement, back from the advice days, they were actually really hard to advise, right? Because it was like damage limitation, and it was really hard. I found. But if, for example, you've got maybe a good decade up your sleeve, you've got more options, right? And I think when you're thinking about debt, I mean, often a lot of people don't think about their home first. And maybe they've got a property that suited their needs. Let's say it was kids, or they for work that suited their needs, but it's not really going to suit where they're going to live long term. So maybe bringing forward their retirement move while they're still working. And maybe that pushes pressure on the kids to leave home, or maybe they haven't got the space when the grandkids come. But making that move while you're still working, and particularly if that's into a better asset, rather than just maybe staying in an asset that, when you come back in 10, 15 years time and you try to sell down into your retirement place, that market's run on you and you've lost out there. The second thing is, depending on, where your homeowner debt is, do you use the equity you've got and the income you've got, so the serviceability at the banks, to buy other assets? And, as closer you get to retirement, I feel that property makes less and less sense, particularly residential. Commercials also, and maybe a better option. But, using the equity in your home to potentially build an investment portfolio, and dollar cost average into shares, or maybe it also allows you to, make sure you put the maximum into superannuation because you've got a little bit extra buffer with your mortgage. And so I think it's, not just being, I guess, a little bit focused like a previous generations, is get on top of your home loan. All debt is bad. And you're going to potentially ignore the opportunity that maybe leverage gives you, and to boost your retirement wealth, and to give you more options in retirement. I think sometimes that mentality really holds people back, when they haven't explored, just some options. And it's not say you have to just leverage up to the eyeballs, and maybe you can do it a little bit more conservatively and make sure you still got buffers, make sure you're still not going to have any issues with cash flow, or if something goes wrong with the property, you've got money to cover repairs and maintenance and things like that. So yeah, you can still use debt, but you can still do it in a way that you've still got the buffers to make sure you can survive any changes.
Yeah, one of the things that really stands out to me with you saying that is that question of why, and more broadly understanding how can we use it to make a difference. I've no doubt that you've seen, as I have, you sit down with people and they say, "Okay, I'm whatever years, however years old, and I here's what my property portfolio looks like," for example. And you look at it, and it might be a really deep property portfolio, lots of holdings, lots of debt. But you're also left looking at their overall situation. You're looking at that, not only those assets and that debt in the context of the situation and thinking, why? Like, why do we need to do this? You're already by miles on track. Everything's good. You're meeting all of your goals. Like things are perfect. And we're here trying to take more risk, acquire more assets, and keep doing this. And then the inverse is true. There's also a case for why not. You're sitting down with people that, as you described, might have worked really hard to pay down their home loans to the point where they've got substantial equity in terms of their own personal goals and ambitions and wanting to retire early. There's this really untapped resource of potentially using equity in a home. And the why not is really strong for them, but they just haven't more broadly taken stock of their entire financial situation, was to say, I'm either on track or I'm not on track. And if I'm not on track, what levers are available? And obviously this can be a really good one.
Yeah, I mean, I from the advice days, I mean, I used to love the mentality that you could, good advice is on sort of like a little post-it card, a little, 7 little steps. I feel like sometimes people go way too complex. They're just constantly trying and tinkering and just adding more complexity to their financial affairs. And so usually they're the ones who, often it's unwinding that and it's going, okay, maybe we should take the profit of those properties, pay off the home, simplify the situation and just hold a fewer number of good assets. And then the opposite is true. There is a lot of clients that I feel like they do need to, just saving, paying off the mortgage, putting in superannuation guarantee contributions to super, and maybe topping it up a little bit. They've just maybe missed the trick. They just haven't made a few extra changes that would have made a huge difference if they did it 5, 10, 15 years ago.
Thanks for watching this episode of the Australian Retirement Podcast. I'm Owen Rask, the founder of the Rask Group and Chief Financial Officer of Rask Invest. One of the great things about retirement is you get to switch off your active income and move into a mode where you rely on passive income from your investments. This can be a daunting time for a lot of people. In fact, most people in our community will seek financial advice at this time in their lives. So if you're watching the Australian Retirement Podcast, you should know that we have resources to help you find a qualified and vetted financial advisor. To get in touch with one of our financial advisors or partner advisors, you can head to the YouTube description that's below the video and simply click the link to get taken to a page where you'll find lots of resources for finding a financial planner. We've even created a matching tool which matches you to an advisor that we think may be suitable for your stage of life, your assets, or your goals. And you can also find resources on how to verify financial planners and their qualifications. That's all available in the link in your YouTube description. Let's get back to the show.
What about if we move across to retirees? Is it a case that all debt typically we'd look at all debt as bad debt in retirement? I mean, you were talking before about the fact that we've got you're now at the mercy of variable interest rates. There's obviously you're leveraged, or most often you're going to be leveraged if you've got debt in retirement. Is all debt bad when you get to that point?
Oh, I don't think so. I mean, I think if you've got a lot of there is a mentality for people who are retired is that, yeah, let's clear the decks, let's sell all the assets. And I think, all you want to do is potentially, if a property is, positively cash flowed, if you thought a little bit prior to retirement and you structured it on interest only terms, and maybe it's not putting more money in your bank account, because it's a very small fraction. But if that means you can hold that asset for another 5, 10, 15 years, and not have to use, you don't need that equity, that profit by selling. I think that's a good decision. So yeah, you go in retirement and you're in your 70s and you've got debt, but it's supported or it's backed by assets that you could sell one day. And by delaying those sales, maybe 5, 10 years and trying to time those sales that, a market booms, makes a lot of sense versus just, let's just sell it all down. I had 4 properties, I'll sell 2 and I'll pay the other 2 off. Like, it's very simple thinking. And I think what you want to do is be a bit more strategic. I think also there's a opportunity of, just as you're coming closer to retirement, it gets even harder once you stop working. So if you're getting into this sort of, 3 to 5 years out from retirement, you've got to be really careful at reconsidering your sort of debt strategy. And I think, making sure you're, like I said, on interest only terms, extending all your loan terms out to sort of 30 years. So it reduces the impact of or your obligations from a repayment point of view. That gives you more flexibility and buffers, releasing equity, and even potentially releasing equity on the home. And even if that money just sits in an offset account, I think this is a trick that a lot of people don't do. Then they get to retirement and they go, okay, I've got my house paid off. I've got all my, some debt on my investment properties. But now I want to shift from having an income to having some cash. And their only option is to take money out of their super fund or maybe sell some shares. And what happens if the market goes through a correction? And that's not a good time to sell down your portfolios. You might want to reduce your minimum sort of pension out of your super fund, and you might want to just take some money out of the offset account against your home. And you go, yeah, that's non-deductible debt, but I'd rather be paying a little bit of interest than maybe having basically selling down out of my super or my share portfolio at the wrong time. And so that's a great little buffer. I think it's one of those things that you can just set up. It just sits there. And it's really just a backstop to protect you if you don't want to sell down your assets.
Yeah, brilliant. Many years ago, I was sitting with an advisor who was really pro property, and we were talking about we were running modeling around someone who is just about to retire, and particularly someone who is looking to like retire early, and we're looking to self fund for many many years. And under this model, the thinking of the advisor was that in a lot of cases, in this case, they all had self-managed superannuation funds. In a lot of cases, you'd be better getting a neutrally geared property, buying a really good quality asset, and then sitting it in there just before or at retirement, sitting it in there with a little bit of debt sitting on it, but just neutrally geared, which basically means that your overall costs to service the debt are equal to that of the income that you're receiving from the property. And then that does sit there as kind of that bucket strategy, that high growth type investment set to the side for some time, and then looking to redeem that in the early to mid 70s or thereabouts to fund the next tranche of retirement. And the reason I share that is because when it was described to me, I thought, oh yeah, I don't think that's going to stack up when versus a lot of other options. It actually stacked up pretty well because there's obviously there's a little bit of leverage into this asset, which created some pretty good returns. From a cash flow perspective, assuming that it was a reasonable quality asset, it actually wasn't a bad strategy at all for some people. So that really did open my eyes to the fact that, yeah, sometimes some debt, as long as it's not really creating a big bleed on your cash flow at a time when ideally you don't want to be eroding cash flow as a retiree, not too greatly, that can be a really effective strategy for many.
Yeah, I mean, you can potentially leverage a little bit further into, if you're in that sort of scenario where someone's got a house, they've got a lot of equity in it, and they want to use that equity to buy other investments. I mean, buying lumpy assets in self-managed super funds, I'm not really a fan of that. And that's why it's one of the challenges of owning any type of property in super. You can't sort of sell down bricks, whereas you can sell down, your share portfolio as you need it in retirement. And you are in more of a sell down phase versus an accumulation phase when you're getting close to retirement. So if you are in the situation where you're using equity in your home and your income to sort of build a portfolio, you can go a little bit further into residential property than you would be able to go into with shares, because you've got the rental income on these properties that increases your borrowing capacity versus if you buy shares. But I find it really hard, to be frank, around when someone's getting close to retirement and buying resi property. I think it's one of those things where I'd much rather, dollar for dollar, whether you're going to make more money in resi property versus, an international share fund or a diversified fund. It's really hard to sort of argue that you would. And the flexibility and to be able to sell down, I much prefer sort of, dollar cost averaging that into, say, shares. And I think personally, and that's not what most mortgage brokers would say, right? Because most mortgage brokers are trying to push the debt and, property is the only thing. But, just from the advice background, I feel like you've got to be a little bit strategic, and it's not all property, it's not all shares, but you've got to sort of really weigh it up. The benefit of property, though, is probably just market volatility. As you get close to retirement, the anxiety I feel that the clients have is really high because that earning capacity is really reducing. And if you get made redundant or something happens to your health, you haven't got that time to catch up. And I think when people invest quite heavily into shares at those years, particularly if they haven't got that, comfortable with volatility in the, say, 30s and 40s, buying a $600,000 property, that's really easy. They don't value the property every day, but buying $600,000 of shares would scare the hell out of them. And so sometimes that's the benefit I find that is clients who just can't stomach the volatility, but they can do that in property. So it allows them to actually invest versus just always sitting on the sidelines and never actually taking any action. But that's just also the overconfidence in the property market, I feel. And often they don't know what they're doing as well because the property market's all completely unregulated. I know this is a really long answer, James, but you've got to be really careful who you get a property advice from because, being completely unregulated, there's everything from the new property spruikers, new buyers agents that are just pumping, regional investment properties to and many different other elements in between, from serviced apartments to, Airbnbs, and there's just hundreds and hundreds of strategies out there. So be really careful whoever you're getting property advice from, because it is completely unregulated.
Yeah, agreed. And I'm going to staple onto that a little bit further. Amount of times that I'm now entering that phase of my life where people are looking at me as a marketing opportunity and saying, "Oh, you beauty, we've got this person in their 40s who would surely have a reasonable super balance by right now. They'd probably be at 200, 250k of super, so they're primed to set up a self-managed superannuation fund and buy a property asset." And that is just a run for the hills type offering for mine, because almost every time I've ever seen the fallout of that, i.e., being someone comes to us in 3, 5, 10 years into the future and says, "I set up a self-managed super fund years ago with one of those sorts of companies who said take control of your super." You come out the other end and you look at it and you like, as an advisor, and you think, if you just left your money with Host Plus, Australian Super, CBUS, wherever, and just kept it in their default balance fund, you would be hundreds of thousands of dollars better off, and you wouldn't have had the headaches of loans, tax returns, tenants moving in and out, SMSF compliance. It's disgustingly oversold for that cohort of Australians, isn't it?
Yeah, it's a easy pitch, right? Australians hated their super funds, right? Even though they've actually performed quite well. I mean, there was obviously people take on the Grady train, taking high platform fees and the fees in the, but that's has changed a lot thanks to the industry super funds and creating more competition there. But people hated their super. They were actually probably performing quite well. They just didn't even know the returns, and they absolutely love property. They're obsessed with property. Property's, the answer to all their problems. And then all of a sudden you're like, oh, I'll just pitch this to them. Why don't you leverage your super fund that you hate into property, and you'll have so much more in retirement? And that was prolific all the way back in sort of 2012, 2013, 14. I remember an old company I used to work at going to home buyer expos, and some of those companies, got into a lot of trouble years down the line because a lot of them were spruiking new property. I thought self-managed super fund lending was dead. I did a bunch of posts on it. All the banks pulled out of it. Parliamentary inquiries were suggesting it should go, but it's come back with a bit of vengeance in the last 12 months. A lot of new lending options to people to leverage their self-managed super funds. A lot of property spruikers, I call them, that are encouraging people to leverage their self-managed super funds. And you can actually borrow more than ever in self-managed super funds to buy resi property. So it is a bit of a danger zone. And if you are considering this strategy, you really have to, understand the opportunity cost of if you just did nothing. And you just kept it in a good fund over the next 10 years, compounding at whatever percentage, and knowing that it would have grown, and you've got to outperform that after tax to make any money. And that's a really simple strategy, set and forget, versus, punting your whole retirement on one property out of 11 million. I just think it's a highly risky strategy.
Yeah, agreed. And look, what's more, if you're listening to this and you're ever contemplating that advice, just seek advice from another advisor. Go and speak to one more and just say, "Hey, I've got this advisor that's recommending this strategy." It doesn't matter who it is, just someone that doesn't have any skin in the game, and say, "What are your thoughts on this?" And I fear that more often than not, that advisor will probably shine a light on the conflicts of interest that exist with this sale, the fact that the property development or developer might actually be paying the advisor or the advisor's company in order to push that product. It's a murky space.
Well, if it's a genuine advisor, a licensed financial planner, and they're recommending this strategy, absolutely go get if it, and often though it's masqueraded in this, I'm an advisor, but I'm not an advisor. I'm a property advisor, and maybe I've got a debt business and I've got a relationship to a developer. And then even in the advice world, they have relationships with property advisors who they've got their own internal real estate license. And it becomes this one man shop. And there's some companies that have actually been taken down over recent years who have really got this strategy wrong because they're clipping the ticket on every level. So just be really careful. I think the whole advice board is you got to be really careful when you go down to the property route. And because unfortunately, I do find that they sometimes build the wrong partnerships there. And so, particularly around self-managed super funds.
That's a thing. Let's move on momentarily to something that we often navigate for pre-retirees. They've got a mortgage that they know that makes sense to pay down before they get to retirement. So let's try to smash that as effectively as we can. But they also have the ability to put pretty reasonable contributions into super. They're working hard. Maybe they're not meeting their concessional contribution cap every year. Now, I'd love to get your views on this because this is that catch-22 of do you build your wealth through the super and get the tax concessions, or do you pay the mortgage off, or a combination of the two?
Look, it's kind of that use it or lose it, right? I feel like the caps on how much you can put in super have come down dramatically. You and I both remember the days when it was 100 grand. That sort of incentive got cut, and then it got cut again, and that's kind of gone up a bit with inflation. And then there is a bit of catch up things you can play, and this is obviously your world, James. But I think once people really understand the tax advantages of, putting money into super versus receiving that and paying personal tax on, it's sort of like a guaranteed return. And I think it's, yes, you want to maybe slow pay down your mortgage a little bit slower, but if you're on top of it, and yeah, you might get to retirement with a little bit more debt than you thought. But if that money didn't get spent, that money got put into super at a lot, and you saved the tax, and that got invested, over 5, 10, 15 years. And who's to say you can't take some money out of super if you need to? Or you might not even need to. You might only have 100 grand owing on your home loan and you're in retirement. And that's totally fine to be sort of affording that from income from your super fund. So I do think sometimes people get a little bit obsessive of, I've got to be debt free and I've got to own my property. And it sort of blinds them from other opportunity costs on investing. They won't invest till their house is paid off. But the reality is that was always going to be paid off anyway, whether it's get paid off at 48 or gets paid off 53. Does it really matter? You're on top of it. And maybe you would have been better off started investing in 48 rather than waiting till when you're 52 and I'm paid off now. I should do other investing. Well, you've just maybe missed 4 years of the opportunity cost of doing other things. And I think that it is a bit harder though when you're really the debt's really concerning. But I think that's a bigger conversation. If you're getting to an age where the debt's really taking a lot of your income's at maybe peak earning capacity, and you're just funneling to keep living in this house, I think you've really hamstrung yourself. It's a really stressful time. I found clients in this situation. And I think you've got to sort of face the music a little bit because what happens is you'll just basically carry that debt all the way through retirement. It'll be very stressful and you basically won't do any other investing for your retirement. And you like punting your super on a self-managed super fund, you're also basically betting your retirement on your home. And that has to grow really well to basically mean that when you downsize, you're going to be able to top up the lost wealth that you didn't create by doing other investing. And and it can be really stressful at times when rates run. So i.e. when rates are higher or you lose your job or you get retrenched, you have to take 6 months to find a new job.
Yeah, perfectly said. I couldn't agree more. Yeah, it's often it's the bigger issue is the amount of debt that you have rather than how do we optimally pay it down. Similarly, I've run these numbers quite a few times for members, and I'm always surprised at well, almost always surprised at how often and the magnitude with which it's better off to put money into super, especially if you can utilize tax deductions, i.e., you can make concessional contributions and pay less tax as a result. That you just can't turn away from that immediate tax uplift of, let's say, 20 or 30% return on investment for that money. It's really substantial. So, so in a lot of cases that will be better. But as you said, it's there's trade-offs here, right? You've got volatility. At some point, you need to pay it down. So if you're mismanaging your super, it wasn't optimally managed to the point where whatever date you thought at this point, I'm actually going to clear the debt and I'm just going to be left with my super balance. If we go through some wild swing at that point, you could get stuck. So all of that needs to be thought about. It's probably the domain for some advice.
Yeah, I think what happens is when you get to the 50s, the typical advice client, right, who's come, they're like, oh, I've got the kids through school and maybe I should think about my retirement now. And it's really hard. You want to play catch up, right? And then you go, look, I can put 30 grand in my super fund. Well, I'm already putting in 15. Oh, okay, I can put an extra 10 there. Oh, what else can I do? And what happens is basically they've use it or lose it, and they've basically lost the opportunity of what they had in their 40s or maybe even their 30s, where they could have been topping up their super funds, and all those small top ups would have added up to a big difference in their 50s. But now they're trying to play catch up, and maybe, like you said, it would have delayed how much they paid off their home. But you can't really just say, "Oh, I want to pump lots of money tax deduction wise into super fund," and you kind of think, "Oh, maybe I should have just done a bit more in my 40s into my super."
Be really keen to get your perspectives on the loyalty tax that can exist. Often when I sit down with people that are growing wealth, and interestingly, it's more often people in their, let's say, 50s or thereabouts than it isn't people in their 30s. People in their 30s tend to be all over their current interest rate and be really, really focused on getting the best rate or at a higher frequency. People in their 50s often develop some complacency around this, and especially if you've got a reasonable amount of either home debt or just debt more broadly across your investments, that can really stack up if you're paying the wrong rate over, let's say, 5 to 10 years. Yeah, do you have a view on this? Like, do you find it's more common for people in that age group than your younger accumulators?
Yeah, absolutely. So I mean, brokers have got 75% of the market share right now, but for younger clients, for example, first home buyers, it's over 90%, right? And so as you get older, that percentage goes down. Now, when you are using a broker, obviously they're not have any of this bias of I've always been with CBA or NAB, and so we've got to stay there. And I'm not just going to walk in the branch and accept the rate they offer. They're going to work hard to give you a really optimal rate, right? They want to, A, win you as a customer versus maybe other brokers or the bank, and then B, keep you as a customer. So that's the benefit of brokers. But even brokers have been really challenged with something called the loyalty tax because, when I started in broking back 2013, 14, a good discount was say 1.2% off the standard variable rate. I remember this client who had that, and I was like, oh god, she's got a big portfolio, and she did. And I was like, and then all of a sudden the discounts went to 1.4, 1.5, 1.6. To a point where they're huge discounts right now. And so what happened is the banks basically took advantage of existing customers, their apathy to review their home loan, and just started offering bigger and bigger discounts to new customers. And so what ends up happening is you started to go further and further out of the market. And so maybe you were paying, maybe just back when the rates were a bit cheaper, but maybe you were paying 6%, but a good market rate might have only been like 5.2%. It was got to over 1% gap between, existing customers and the loyalty tax. And there was a review into the way that mortgage pricing was happening with the ACCC, and it was getting a lot of noise behind it. But back in 2023, all the banks basically started offering all their existing customers really good pricing, and so we went through all our book, but I don't think everyone did. And bank pricing, the loyalty tax problems probably evaporated over the last couple of years, but it was huge just 2 years ago. So, but you're absolutely, you don't have any loyalty to a bank. They won't be loyal to you. It's not like they're calling you up and saying, hey, James, I'm going to give you an extra 20 basis points off your home loan, being proactive. You've got to keep the banks honest. And that's one of the roles that mortgage brokers play.
I think that perhaps dovetails perfectly into my last question for you, mate, which is that idea that a lot of Australians have a mortgage broker. A lot of people listening have a mortgage broker. I mean, as you said, like say 75% of Australians, the non-younger accumulators, are with an independent broker, so to speak. The rest presumably are with a bank, which is madness in my mind's eye. But but that's a separate conversation. How can people know that they have a good broker? What are the hallmarks of getting the most out of your relationship with a mortgage broker?
Look, I think the ticket to the game is pretty low, right? To be a broker, from a education point of view, and there's 20 odd thousand brokers. I think when I started, it was 14,000. So there's been an explosion in new brokers. Some are doing part time, some are full time. So firstly, are they doing it full time? Is this their only job? Um, you do want someone with a bit of runs on the board, like because it's your credit file they're playing with, right? So they're lodging loans for you. You don't really want to get declined loans unnecessarily because they just didn't know what they were doing. There's a little bit of, I think the first thing is are they a validator or a facilitator of your loan? I just think, you probably should expect a bit more. Are they sort of challenging your thinking? Are they giving you sort of advice? Are they sort of, explaining, structuring to you, not just saying, how much do you want to borrow and who do you want to use? And, are you okay with that? I think it's just they should be adding a lot more value than that. So that's probably the mindset, I think, of a good broker versus just someone who's maybe just doing the job for the sake of it. We should pretty much all get the same rates from the banks. It's not that one's going to get you a lot more because they, have been around for a lot longer, or they lodge a lot more loans. Like that's a little bit of a furphy. Sometimes we get a bit of better experience with the banks if we're one of their biggest supporters. There's like different channels that we get through, but yeah, really, they've been around for a while. They're trying to add value. They're trying to educate you. They're really open and available to ask questions, and they also challenge your thinking. And in particular, if you're doing any type of property move, there's someone you can sort of bounce it with. And they're not trying to partner you up with some spruiker or developer. I think that's sort of a one where you need to run from, because I think they're thinking about their own pocket versus your pocket. Yeah, but they're also, it's not like they're licensed through a certain organization. There's only a few aggregators. We've all pretty much got access to every lender because every lender wants to work with every broker. It's more how they make you feel and the role they're playing for you. Do they actually know what they're doing, because they're doing it full time and they're actually lodging quite a lot of loans. And ideally probably got a bit of a team. I do think it's really hard for one-man bands because there's just so many hats they've got to flip, from data entry to doing the strategy to speaking to BDMs to staying on top of products to talking to clients to the technology, the aggregator, compliance. So there's a lot going on for them. And usually you probably want to work with someone who's got through the trenches of the first couple of years and now got a bit of support, so now they can be focusing a lot of their energy on just helping you rather than getting loans through lodging loans.
Yeah, perfect, mate. Well, thank you so much for being on the show. I love chatting with you because you're such a straight shooter, and it allows us to really get to as much value as possible. So thank you very much. Everyone, if you're listening, again, as a reminder, if you haven't already jumped on the Australian Property Podcast, then you'd be crazy not to. Go and do it. It's with Chris and Pete. They've got a huge amount of episodes about property, the state of property right now, things that people should be doing and thinking about. Definitely worth adding to your regular listens. Also, I'll give you a plug here, Chris, which is that if you want any support, of course, from a broking perspective, hit up Alcove. But to add to that, if you want some terrific insights, go to this bloke's LinkedIn page, Chris Bates, because you are king of just putting good quality content out that's just very, very good, very, very just really deep information and valuable insights about the market, about marketing, about the property market and about lending. So thank you very much for continuing to do that.
Thank you, James. Always always enjoy the chats, mate. Thank you.
Ripper. Okay. Thanks, everyone. We'll see you very soon.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.